All right, everyone, let's get started with the earnings indicator. So I just populated on my chart. And first of all, the arrows mean absolutely nothing. I'm not going to lie, I made this so many years ago that I forgot what we told the programmer. And I think there was just updates to toss and stuff. So you can remove the arrows if you want. There's no, don't remove the indicator, but don't listen to the arrows. They mean nothing. Again, this is very old. So what it does is it showcases the market maker's implied move. So if the stock has earnings for the week, it will showcase the market maker's range from the high to the low. So what it's doing is it's taking the implied move, which Thinkorswim will showcase. And you see Lennar right here. This MMM means market maker's move. So it's about $9. So you would take $9 higher, $9 lower from the underlying stock price. So with Lennar at 155 plus 9, that will give us an implied move to 164 to the upside, and to the downside, that will give us 146 to the downside. So let's go ahead and just make sure it's right. Chart, look at that. Pretty much to the T, right? Minus a few pennies here and there. So what you're looking for is if you buy calls on Lennar, again, don't look at the arrows, they mean nothing. If you buy calls on Lennar, you want Lennar to be over that 164 mark for the calls to pay. I'm going to assume the 164 or 165 calls are probably, does Lennar have weeklies? It does. I'm going to assume they're probably around $1.50. Let's go ahead and take a look. They have 165 calls. Look at that. They're about 160 or so. I've been doing this for quite a long time. And then on the downside, that would be what? 146 or so. And they're right around there, 160. Actually, about 170 there as well. So that will give you the range. So if you're bullish on Lennar, you think Lennar crosses 164 to the upside, you would have to look at the calls. So the 165 calls are about 170. So 165 plus 1 or 165 plus they're about $1.70. So you would do $1.70 that would give you a 166.70 would be your break even to the upside. To the downside, you pretty much just do the inverse there. So you would look about 146 and you would need the stock to go below 143.30. Good Lord, I'm trying to do math in my head here. So that's how you would use it. If you think Lennar stays within range, all you would do is you would sell premium. For example, let's say I think Lennar has a less than market maker's move on earnings. So it stays within the range. That's what the shade block is in. I could do me like a iron condor. Maybe I could sell bear call spread. I could sell bull put credit spread if it's in the range. Usually if a stock goes above the market maker's range, it has what we call a greater than expected implied move, and the stock usually carries higher. So if it exceeds the market maker's implied move, it will usually go in that direction more. If it stays within the market maker's move, like let's say Lennar has good earnings and goes to 160, we would call that within the market maker's implied move, and the stock would usually just do something like this. Pop and then just peter sideways. So that would be something where you sell premium in the range that's good. If you get a greater than expected market maker's implied move, then that's when you want to go directional buying a call for the upside and a put to the downside. Or what you can do if you're long stock and you get to the market maker's move, let's say I have Lennar stock at 155 and Lennar goes to 164 at the open. So right at the market maker's implied move, I can use that to take profits and to get out. Same with the downside there. So you want to see a gap higher over the implied move for the stock to make a run, a gap and go, or gap lower for the stock to get crushed and then the puts go up in value. If you have anything within the market maker's move, that's when you're going to get sideways, and you could do strategies like, let's say I'm neutral in Lennar. I could do something like I could sell the 165, let's say 170 bear call spread. That's a horrible risk versus reward. Maybe I could sell the 165, 167.5 bear call spread. That's also a horrible risk versus reward, but let's just use it for shoots and giggles. And I could sell something like maybe the 144, 143 bull put credit spread. And I hate that trade because I'm not a spreader, but you could. You could do that kind of jazz. Just not me. Maybe I'm slightly bullish on Lennar and I want to sell, let's say the 145, 144 bull put credit spread, I get pennies on the dollar. I would never do that. But let's say I think Lennar stays flat, maybe it goes down a couple bucks. I could do something like the 150, 149 bull put credit spread and, you know, try to get something for it, maybe like 40 cents, maybe 35 cents, something like that. So that's how you pretty much use it. What I would do too is I would look at the history and see if the stock is a gapper or if it's within, or if it usually stays within the market maker's implied move. When I say if it's a gapper, let's look at Lennar. I like to look back at the previous 4 earnings quarters, and we would see Lennar had a nice gap to the downside here on earnings. That was about what, $5? That's pretty good actually. No, more than that, 165. Damn, about $10. So that's a gapper. Hence why the implied move is $9 this quarter. This earnings here had a nice gap to the upside. Okay. Nice gap there. So it is a gapper. So maybe you do want to get directional on something like this. This earnings pretty much nothing back here in September. So it does have a history of gapping. Again, just make sure you use proper risk versus reward. And I am out.